Hey traders, Barry Burns here, Top Dog Trading. Today we're going to talk about average true range, or what is often called the ATR indicator. Now, this indicator can be used really well, but it is often completely misunderstood, and here's why. Most traders, when they're looking at indicators, they're looking at them very simplistic. So they're looking for the angle of the indicator to be moving in the angle of price, and preferably before the price move. So the first thing is, what is average true range? It measures volatility. And volatility has really nothing to do with direction. So this is how most people would think of volatility, and it's not completely wrong. They would say this is a low volatility move, narrow range swings, and this would be a high volatility move, big move up, okay? And so one simple way of looking at this, which again is not necessarily wrong, there's some truth to this, is I like to do these geometric drawings. So a wide range, in other words, a tall rectangle, if we draw it from low to high, that covers a short period of time, that would be considered high volatility, big swings, big price moves, and a lot of people like to get these because, well, great risk-reward ratio, right? We only get the big moves, the home runs, the grand slams. I get it. And then in these sideways movements here with the rectangle that's longer in time and more narrow in price range, that'd be considered low volatility. Choppy markets tend to avoid these. Okay, and those are all good thoughts. However, let's go and look at something here to show you why that is a little simplistic and can actually get you into trouble. All right, so now I have switched over to a daily chart of the spiders. And as you can see, we've got a nice move up, pretty dramatic move up. And so you would assume, oh, that's a high volatility move. And people do this where people get really messed up, really get hurt. I'm trying to not get you hurt here. I'm trying to prevent you from getting hurt by doing this tutorial. They scan for high volatility markets because they want those big moves. And so they'll scan for high vol or high volatility markets and try to get into those. Now, here's the problem. All right, let me take the arrow down, but I'm going to keep the same chart here. I'm going to bring up their ATR indicator. Okay, we can use the default, which is 14 periods. And now you're going to be asking yourself, what the heck is going on? How come there is a big move up in price, but if you're scanning for high volatility or high ATR, it's actually going down? So if we do our geometric patterns again, you'll see that actually what we have, there's the low of this move and there's the high. So with geometric pattern, look, it's longer in time than it is high in price. In other words, we don't have that rectangular pattern that I showed you before where it's a high rectangle and a narrow rectangle. But if you don't do that little technique there and you just look at the price, you'll say, oh, that market's really moving, and it is moving. That's a very nice uptrend. I'd be happy to take that uptrend. But scanning for high volatility markets, not going to get me into that. Now, when we do get the high volatility, the high ATR, again, I'm just using the default to 14 periods here, right there. What happens? Okay, so volatility, now ATR goes up, showing high volatility. Okay, and then if we draw our little rectangle here, look what we got. We got, again, a high rectangle and a narrow range rectangle in time. Okay, so again, just the little geometric pattern can illustrate this, I think, very well. Look at the range of these bars. So the big picture is, yep, going up, no question about it. But look at the bars it's going up on. Very narrow range little bars, very narrow range little bars, narrow range little bars, narrow range. See how narrow range these bars are? Okay, that's part. There's more factors involved as to why this is a low volatility move. Now, look as it comes down, look at the range of the bars. Huge wide range bar, right? A lot of these bars are very wide range, much more so than when we went up. So it's kind of like a roller coaster. You're going up, the direction is up, but again, people oversimplify indicators and they just think, oh, the indicator gives me a signal when it's moving in the direction of the trade. Now, here's another common mistake that people use with the ATR is they use it. A lot of people advocate it as a way of getting out of the markets, as a trailing stop, so to say. So they'll say, okay, if the market's going up, and let's say it did go along here, then I see a divergence with ATR. So we've got price going up, we've got ATR making lower highs. So higher highs on price, lower highs on ATR. Oh, we should go short. Okay, and if you didn't do that one, then maybe do this one. Okay, higher high on price, lower high on ATR, get out. So they'll either go short if they're initiating a position, or they'll just use it as an exit if they're already long. Again, another divergence. You can trade these divergences all the way to bankruptcy. Okay, so not such a great idea. I don't advocate doing that personally. So that's another misuse of it. It's not necessarily bad to be in a low volatility market. Again, what happens is, going back to the range of the price bars, it's easier to put in a trailing stop, a trailing stop such as, well, if we're long, direction, remember, direction and volatility are uncorrelated. So when you're going up here, and let's say you want to place a stop here as a protective stop. Look, your entry, wherever you get in here, because these are more narrow range bars, if you enter here or here, wherever you get, and your stop is there, it's going to be a very tight stop because it's a low volatility market. When you have high volatility markets, then let's say that you went short here, okay, and then your stop would be above the cycle high. Now, I totally know you can do other types of trailing stops that will be tighter. The problem is, in a high volatility market, again, because these bars are such wide range, you get not only, you don't think that you get a clear unidirectional move in the market. You don't. Each of these bars is very volatile. They swing up and down and up and down, and therefore you can get if you place your stop too tight or too close to your entry in a high volatility market, you could get stopped out unnecessarily when the big picture is still good, still on your side. So I actually prefer low volatility trends to high volatility trends because it's just more clear, narrow range bars, can keep my stops tighter, my trailing stops tighter, and I don't get all the noise and the wide swings in the market that go crazy, take out stops, and then go in your same direction. The market can also, in a high volatility market, the market can gap not only in your direction, it can gap against your direction. And if it gaps against you, then even if you have a protective stop put in, even if it's a hard stop with your execution platform, you may not get filled at that price because it may not trade at that price if there's a gap. And then, well, then you're at the mercy of the market, whether you've got a market stop or a limit stop. Either way, you're still going to be hurt. And the answer to that is to hedge your positions with options. So that's it for today. Still offering my cycle indicator for free. If you'd like to get that, go on over to indicatorwebinar.com. And at indicatorwebinar.com, I'll give you the indicator. It's an indicator already in your charts that we modify to turn into a cycle indicator. And it's recorded, so you can watch it anytime you want, whatever fits your schedule. So thanks again. Like this video, subscribe if you liked it, share it with other people, and have a great trading day.